Why is the real estate market booming? Because it is, like nothing we've ever really seen in our lifetime. So let's take a look and evaluate how long this boom will last. You ready? Let's go. By the time we're done here, you'll know exactly why the real estate market is booming and why we're likely not in a bubble and what you can expect the housing market to do from here. Oh, and by the way, if you're still looking to get that first deal under your belt, I put together a free training just for you to help you get that first one done. And then from there, I'll show you how to earn $5,000 a month flipping contracts and properties working as little as 1 hour a day. And you can access it at mattsfreetraining.com. All right, so you may recall that during the pandemic, housing inventory, it dropped as sellers hesitated to put their homes up on the market. And that glaring lack of housing supply created a boom in home prices. And still today, in most parts of the country, sellers are getting away with charging a premium for properties that just 2 years ago would have fetched far less. You know, the US housing market was an unlikely beneficiary from the COVID-19 pandemic, but the boom was inevitable anyway, and I'll explain why in just a minute. But, you know, over the last couple of years, home prices have climbed at a record pace. The median price for an existing home reached over $363,000 in June of 2021. That's a 23.4% year-over-year increase. And then today, just about a year later, it sits at $408,000. That's another 12% year-over-year jump. I mean, we haven't seen such a dramatic acceleration of home price growth like this in decades. The market is slowing down, but we're still very much booming as opposed to bubbling. You know, the word bubble, it gets thrown around pretty loosely because most just can't believe how much prices have gone up. You know, a bubble, it tends to be something that's inflated that could burst at any minute. And that's not really the case right now. You know, while speculation can be considered as a contributor to the rising market, the main cause for the housing boom has been low mortgage rates. And at the start of the pandemic in March of 2020, the 30-year fixed rate mortgage sat right around 3.5%. By July of 2021, that number had dropped to 2.9%. The market has been slowing in growth since rates jumped above 5% recently, but still, historically speaking, the rates are still very, very low. Now, supply, this is also an issue. You know, according to the National Association of Realtors, the U.S. has underbuilt its housing needs by at least 5.5 million units over the past 20 years. That's a stark comparison to the previous housing bubble in 2008, when overbuilding was the issue. And with the price of building materials rising, it's becoming more and more cost prohibitive for builders to build new homes, thus represented by home builder confidence falling for the last 4 consecutive months. So we've got a boost in demand that's due to record low mortgage rates, and we've got a shrinkage of supply, of which is a recipe for rising prices, the fastest pace since the 70s to be exact. According to every available measure, median home sales prices in the U.S. are at a record high, and they're just starting to show signs of cooling off. But prices are still on their way up in most parts of the country. And to some, this brings back memories of the real estate debacle of the 2000s. And they wonder if this bull market will end up, like then, in a big crash. Well, good news. If you're already a property owner, today's strong housing market is radically different, far healthier, and it could chug along for many more years. The U.S. housing market is still in somewhat of a frenzy as pandemic-induced demand and maturing millennials put buying pressure on a long-standing housing shortage. The press has noted that more than 6 million homes may be sold this year, more than any time since 2006. For those familiar with real estate busts, this may be an ominous sign. And understandably, a roughly 3-year housing boom ended in 2008 as real estate prices plummeted, ultimately sparking the global economic meltdown known as the Great Recession. As much as $16 trillion of home value got completely wiped out. Economists argue that this time is different though. And although this time is different, that those can be very dangerous words to say, I tend to agree. You know, tight supply and rising demand as opposed to lax lending standards are driving the current boom. So while the housing market in 2006 was a bubble waiting to pop, this one appears it will be propped up by the entry of a new generation of buyers into the market. With all that said, if you're still of the feeling that we're more likely in a bubble than we are going to continue to boom, consider this. In large part, the previous housing crash was driven by an unprecedented wave of subprime lending, which was itself spurred by a demand for mortgages among investors. Exceptionally risky mortgages with high, often variable interest rates were offered to borrowers with poor credit histories. And then by 2006, 20% of U.S. mortgages were subprime. When home prices went down, many of these borrowers defaulted, triggering a systemic collapse. Well, economists aren't concerned about a repeat of the previous housing crisis, partly because the fundamentals of mortgage lending are much stronger this time around. Banks over the last decade have likely underwritten the best book of business that they ever have. So today, subprime lending is much less common, thanks in part to federal regulation that has set stricter standards. Between 2009 and 2014, subprime mortgages only made up around 1% of all U.S. mortgage originations. Translation, 99% of all mortgages today have been given to prime borrowers. And today's loan products and underwriting guidelines no longer allow for borrowers to take as much risk. There's a lot of skin in the game, and the ability to repay is a large consideration for banks. If the market does crash, it won't be the bank's fault this time, nor will it be artificial demand. This time the demand for real estate is real. The number of Americans who can reasonably afford a home and are now looking to buy one is rising even while inventory remains stagnant. The pandemic contributed to this in three ways. One, the number of new homes coming onto the market slowed as existing homeowners decided not to sell. Number two, emergency federal protection allowed people who had lost income to pause mortgage payments for a time. And number three, the supply chain. Supply chain and labor shortages left builders scrambling to get new houses up fast enough to meet the demand. All of this indicates that high prices reflect real demand by home buyers, not just a speculative bubble. More Americans just want new homes and are equipped to properly finance them at a time when few are available. And then there's the demographic shift. What will have a greater impact on the future of the housing market than anything that I've shared with you up to this point, a factor that most are not talking about yet. If you want to know what that factor is, let me know by smashing the like button. Super. Appreciate you for that. And if staying up to date with the housing market is important to you, click the subscribe button, because that's what we do here multiple times per week. Now, this demographic shift that almost no one is talking about is that millennials are finally buying homes. And this is a really big deal because a big part of the demand equation is that Americans between the ages of 25 and 40 are finally buying homes in numbers mirroring that of previous generations. The Great Recession of 2008 and 2009 had delayed home buying dreams for many millennials who entered a difficult job market and lost the ability to build savings early. Because many couldn't afford to buy homes, those homes, they weren't built. Builders look at these types of things before they drive a single nail or even pull a preliminary permit. There were probably 6 million houses between 2008 and 2013 that should have been built, but weren't because millennials weren't buying. So that brings us to today, where there are millions of home buyers who can't find houses because there aren't any. Even though homeownership remains out of reach for many millennials, they now represent the largest segment of Americans entering the home buying market. Millennials are now earning more money and starting families later than their predecessors, but they're finally here and they're looking for houses. All of this means that what looks like an exceptionally active housing market is actually just the beginning of a general shift. While this demand was always coming, the shifting incentives of the pandemic, as well as low interest rates making more financing available, just sped things up. So, what will happen to U.S. home prices from here? Just a few months ago, most experts were predicting that home prices, as well as the rate of home buying, would not slow down or return to normal anytime soon. And it's still being projected that 4 million mortgages will be originated this year, and there will be an annual increase in home prices of between 5 and 13% over the next 3 years. This should pose a challenge for those trying to enter the home buying market for the first time. However, with aggressive inflation, the struggling economy, rising interest rates, and tightening monetary policy, these big economic variables could turn last year's predictions on their heads. But we still love to make predictions, and with these latest economic developments, I've revised 5 of mine for you. Prediction number 1. Mortgage interest rates will rise. And that's not really a prediction, right? Because we've already seen rates rise in the early months of this year, and there's a consensus that they will continue to do so, and rather aggressively. Prediction 2, expect less intense competition. If you're in the market for a home, this year should mean less competition. The combination of rising interest rates and rising house prices will push some would-be buyers out of the market, which may result in reduced competition after the summer buying season is over. But it won't kill competition, likely just the intensity of it. Prediction number 3, home price appreciation will slow. But just how much will it slow is up for debate. Recently released research from Zillow shows that annual home growth is expected to accelerate through spring to 17.3% by the end of the year. Fannie Mae says home prices will climb 11.2% throughout this year, followed by a more modest increase in 2023. But the National Association of Realtors, which surveyed more than 20 top economic and housing experts, predicts that housing prices are expected to climb just 5.7% through the end of 2022, of which this more modest prediction would still mean properties are still appreciating at almost double the normal annual rate. I think you can expect to see the greatest levels of home price appreciation in rural and suburban markets where individuals can benefit from a stronger, resurgent economy. And another thing to consider, higher interest rates will force buyers to shop at lower price ranges so they can afford the monthly payments. So I see demand and appreciation to increase for your smaller homes, which will over time indirectly cause and accelerate gentrification in your lower income neighborhoods. Investors with the ability to withstand whatever the economy may throw at them in the short term could benefit greatly long term by purchasing these smaller properties in lower income areas. Prediction number 4. Pricier homes will be easier to get. Based on the previous prediction, we're already seeing homes priced at $500,000 and below disappearing fast, while supply at higher prices has risen. There are more properties for sale at the upper end now, homes priced above $500,000 compared to a year ago, which should lead to less hurried decisions by some home buyers. So if you have the means, finding your dream home will likely be less stressful than it has been in the last couple of years. And then prediction number 5, we're going to see more foreclosures. Now that mortgage forbearance programs have come to an end, we're likely to see a normal foreclosure market resume. Most homeowners that are flush with equity and can likely sell on the open market for full retail if times get tough. But as the economy moves forward with great uncertainty, especially with the pressure inflation is putting on the average American, life will start to get back to our pre-pandemic conditions where shit happens to people. Face it, life comes along and kicks us all in the teeth every once in a while. And when it's something that only a large amount of money will cure, more and more people will turn to their properties for financial relief. And that could mean selling quickly at a discount, or simply walking away and letting the bank take it back. If you'd like to dive deeper into finding foreclosure opportunities and others like this, I put together a free training just for you to help you do that. You can access that right now for free at mattsfreetraining.com. And I'll also put a link in the description for you below. That's all for now. See you next time. Thanks for watching. Take care.